Hello again, investing putts with you. Got 7 subscribers now. Woohoo! So I'm not quite talking to myself, but so if you post a comment, I'm sure a second to read it because there's only 7 of you looking at it. Anyway, it was a pretty wild week in the markets. The SPY was down more than 2%. I was trading cash secured puts on 2 stocks where I got assigned the shares. The first was WBA or Walgreens. The second was SLB or Schlumberger, which is an oil services company. There were 2 other companies that I was selling vertical put spreads rather than cash secured puts where I took a loss. The first was Cameco or CCJ, uranium miner. The second was Occidental Petroleum or OXY. Still, all that matters is how's my portfolio performing against the SPY. Doing very well. I'm down only 1.8% from the peak this week. Still beating the SPY handily and less volatile than either the SPY or a SPY bond mix. I'm up about 6.4% over 2 months, so that's pretty good. Here's my current holdings. If you want to take a closer look at them, just hit pause. But 2 new ones, Dish Networks and Weight Watchers. Both of them appear to be fairly undervalued. They have earnings, fairly low PE ratio, and both pretty good premiums, which is kind of the stocks I'm looking for. So I prefer to focus on failures more than successes. Otherwise, you don't really learn from your successes nearly as much as failures. So anyway, let's do a post-mortem on Walgreens. It's been on a tear since I started trading it 3 weeks ago. I've been very aggressive with my put selling. So as soon as my put loses 2/3 of its value, I buy it back and I sell another 30 delta put. And if I've only got I have more than 3 days left till expiration, I sell at the same expiration. So in some weeks, I was able to sell 3 options with the same expiration. This worked great when the stock was marching up in a straight line, but it left by being so aggressive, it left me exposed to even a moderate pullback like we had this week. So in the future, I think when a stock makes a big upward run, I'm going to be more conservative with my option selling. Implied volatility tends to drop during a bull run, so it's tempting to get even closer to the strike price, to the stock price, to collect those premiums. You look at the yellow oval. I bought back 54 strike put, and I immediately sold a 55 put at the same expiration, but then the stock price started to crash. I could have sold another 34 put at the next expiration cycle, which was March 26, but instead I kind of went for it, and you can see the stock tanked right at the end of the week, and I was left with holding the bag on like a 2.5% loss. So what do you think? Should I have rolled it out in time, or was I right to keep chasing it like this? I like to keep a running sum of the P&L, which is the graph on the right. So when I sell an option, the P&L jumps up. When I buy it back, it drops slightly. So this repeating pattern looks like a saw blade. And when I get assigned the shares, the P&L drops. So in this case, I gave up all my gains from selling 8 put options, and I'm actually slightly underwater. So this tells me that WBA might not be a good candidate for trading the wheel. If the expected drawdown is larger than the sum of your premiums over 8 option cycles, then you're losing money and you're not being compensated for the risk. So I'll keep the long position for a while, but I'll go through another cycle of the wheel. But if I don't like what happens in the next drawdown, I'm going to let it go. SLB was the other stock where my put was assigned. This stock has fallen 10% in a week, which is kind of expected. So when it was topping, I got paranoid and I did not sell an aggressive put like I did on Walgreens. So notice how I bought back the 29 strike, and I moved the strike of the put down to 28.5, even though the stock was still going up. So as a result, my drawdown wasn't as severe from the loss, and I was able to preserve some of my gains from selling these puts. So Intel did something interesting this week. I sell put spreads instead of cash secured puts, mainly to preserve my buying power. I was previously getting 35 cents from selling the spreads, but on March 19th, Intel started the day down severely, which spiked the implied volatility. However, the stock price rose into the afternoon and my put spread went far enough out of the money that I could buy it back cheaply. But still, the implied volatility stayed high, and I was able to sell another put spread expiring on March 26th for double the usual premium, or 64 cents. The short leg of this spread is 3% out of the money, so this is unlikely to get a sign next week. Earnings don't happen until late April, so I don't know. It just happens sometimes. I'm not sure how you can predict this kind of event. You just have to be in the market to take advantage of it. So anyway, as always, look forward to your comments, questions, feedback. We'll see you next time.